Here are the two charts. This one here is 2007. You can see down at the bottom, the stock market put in a high. It pushed to a nominal new high while gold was running up. As the stock market started to sell off, as we just scroll forward, you can see gold continues to run and shoot higher for that final big push higher. And I believe that's where we could be headed. We have on right now the stock market, we've hit this new high. Market's starting to roll over. Gold's starting to run. We could see the stock market sell off in a big way, and gold shoots up to 4,100 an ounce US. That is our next upside projected target based on the gold chart. And so that's kind of what we're looking for. Eventually, gold will sell off. You'll see eventually it does peak out, and when there's enough selling in the stock market itself, it will pull gold down with it.
Short-term catalysts include speculation about a rate cut after weak U.S. labor data, a weakening dollar, and rising tariff-induced inflation, all of which are boosting gold's haven appeal. In terms of a potential bearish case for gold, an unexpected drop-off in central bank demand remains the most significant fundamental risk, the central bank said. The speaker, Chris Vermeulen, predicts gold reaching around $4,100, but this seems unfavorable because a gold price of $4,100 would likely reflect severe economic stress in the U.S., such as high inflation, a weakening dollar, or a financial crisis. While it benefits gold investors, it generally signals a decline in economic confidence and a loss of monetary stability. Chris Vermeulen, founder and chief investment officer of the technical traders and AlgoTrades, explains that stocks hit new highs. Still, a price of $4,100 per ounce for gold would probably indicate severe economic strain in the U.S. and around the world. Investor flight from risky assets into safe havens, frequently during recessions or periods of extreme financial instability, is typically reflected in such a rise. Due to a dramatic slowdown in corporate investment and consumer expenditure, U.S. GDP growth is likely to be close to zero or negative. A falling dollar or ongoing supply shocks could cause inflation to stay persistently high, between 6 and 10%. The Federal Reserve would likely aggressively lower interest rates to combat economic contraction after they peaked, which would further raise gold prices. A sharp decline in the value of the U.S. dollar could undermine trust in it as the world's reserve currency. While metals like silver might enjoy rapid increases, stock markets could experience sharp drops. A gold price of $4,100 would indicate a combination of currency instability, financial anxiety, and economic stagnation. However, Chris is prepared for this new outcome of gold, as he relates it to 2007, when gold surged as the stock market peaked and began to decline. The same pattern may be repeating now. Stocks have hit new highs and are starting to roll over, while gold is rising. Before we begin, please subscribe and click the bell to stay updated. We'd love to hear your thoughts in the comments.
Now, the market could just push to all-time highs. Nobody knows, but our analysis is saying close position, lock in the profits, and wait for a fresh new setup to get back into the equities. And we're going to move our money elsewhere to protect it and just make sure we don't give back any more gains than we have to. And that's kind of where we are from that perspective. Now, a few things did come into play. So we had the previous day, we had the market close with panic selling, which typically means if we have panic selling, it's kind of the opposite of FOMO. If everybody's dumping shares, short-term traders, they've driven the market down, they've exited, usually the market's going to bounce. So not only that, but we had this lime green area. This is an oversold market condition saying, hey, the market is oversold. It should have a bounce when we're in an uptrend. So we had oversold, which again is an indicator I share in the book. And we have the panic selling. And that told us yesterday we're probably going to see a bounce and some type of move higher, which we got. If we actually look at the put-call ratio back on this day, this sell-off day when people were dumping shares, we saw the put-call ratio. Doesn't look like much, but it gapped up higher and moved up. People started buying put options. People quickly went from being super bullish, buying calls, leveraging themselves, thinking the market's going higher, to one day they flip and they're like all buying put options, betting on the falling market. When people are betting on a falling market, usually it goes the opposite way. And so that's kind of what, that little scenario that has unfolded. And if we go back to the S&P 500 here, and I pull up our short-term cycle indicator, you can see when we have the lime green are stronger cycle lows. These are much shorter cycle lows in the market, and we just had another lime green cycle low. So these are very short-term cycles. It only means the market has to bounce for one day. Again, this short-term cycle analysis goes more or less with the 30-minute chart. But we had that cycle low on this close. It carried over yesterday, and the market is trying to bounce for just a short-term bounce, which is what we had yesterday already. So a lot of things kind of lined up for that. Now, let's take a quick look at the sentiment chart. If we look at the sentiment chart of it doesn't matter if it's the SPY or the QQQ, which is our gauge for the NASDAQ here. If we go back, we'll just go to the SPY. If we go back here and we take a look at our sentiment chart on the right, these deep red bars I mentioned yesterday in the video saying, hey, there's definitely some change going on. This means there's more so, I said yesterday, blood in the streets. That's why they're deep red. People are worried. They're starting to, people who literally bought recently are under pressure. There's some big institutional selling, some big volume selling going on, a lot of things behind the scenes. This can lead to, obviously, like the big sell-off we had earlier this year. So there is a bit of a shift going on behind the scenes. Even though yesterday's stock market moved higher, we still saw things breaking down behind the scenes. And that's what the stock market does. It does camouflage. This big rally day has most people thinking the markets are going higher, has them very bullish. They're going to pile in today at the open and probably pay a higher price, only for the markets to collapse and fall and go down, and then they'll eventually shake out and take a loss. So sentiment is definitely giving us a warning as well that things are changing underneath the hood of the markets.
As the fallout from Tuesday's dismal U.S. non-farm payrolls report subsides, the U.S. dollar is reducing its losses. The impact of weak U.S. macroeconomic data and market expectations of an impending Fed rate reduction are being counterbalanced by declining oil prices, which are hurting the Canadian dollar. While the Canadian dollar is expected to weaken in the first quarter. However, CAD investors may reassess prospects as the year progresses, focusing on the dynamics of Federal Reserve and Bank of Canada policy. In 2025, politics will be shaped by Trump's return to the White House, with markets viewing a Republican government positively but facing uncertainty from his tax cuts and tariff plans. In Canada, a no-confidence vote in late 2024 ousted Prime Minister Trudeau, triggering snap elections and leaving a weakened Liberal minority, which fueled policy uncertainty. Economic challenges and unstable governance weigh on market confidence. The Bank of Canada is expected to cut interest rates faster than the U.S. Federal Reserve, widening the rate gap and adding pressure on the Canadian dollar. Let's resume the interview now.
In fact, the long-term chart, when we look at the long-term investing trend, this is the weekly chart of the S&P 500. What we have going on under the hood right here is almost identical to what happened over here as well. Now, we had that over here, and these two were the same type of setup. And now, again, it's the same type of setup. We did go into a 20% correction there. And again, we could potentially see something pretty big happen. Whether it happens or not, it doesn't matter. It's not about me calling the direction and nailing it. It's about us trading the trends and changing gears and changing direction when we need to. And that's what I think a lot of people get confused is they want me to make a call and be right. And when I'm not, I take the heat. But really, it's not about me being right. It's about how do we follow price? How do we manage positions? And I can be wrong almost every trade with my opinion, but we still nail it with the strategy and make money. And that's where people need to differentiate. Don't listen. Don't trade what you hear. Let's trade what the charts tell us to do. I'm constantly warning of fear of the markets could correct because you need to protect your capital. And if I just say, go buy all this stuff and buy like everyone else, eventually you're going to lose a ton of money. So I'm always about protection. And as long as we have a plan to protect us on the way down, even if the markets don't go down, it doesn't matter. At least we have a plan to execute if it happens. And so that's kind of where we are right now is the NASDAQ has moved us out. You can even see the semiconductor space. It's bounced from oversold condition and has had a nice bounce. But overall, the markets are going to gap higher today with FOMO, I think. We could potentially see it sell off in the stock market in general, and it could head a whole lot lower, or maybe it wants to grind up a little bit for another session or two, and it could roll over. Either way, there is a pretty big sentiment shift happening behind the scenes. In fact, just look at the volume. It really ramped up on this little sell-off here in these past couple of days. If we just zoom back in time, we had a big ramp up in red bars over here. On that breakdown, we had a ramp up in bars over here before it had a bigger washout and sell-off. We never know if it's going to be a 3%, a 8%, a 20%, or a 50% multi-year correction. We always have to protect ourselves every time the market rolls over. It's got up. We've seen the exchange get way up here, this 146 level several times. Each time it's been hit pretty hard. It has been hit hard again. We do have this kind of support zone that it has settled down into. And when we zoom in on that chart, I am still bullish on the dollar. Most people are very bearish, which is good. Generally, I don't want to be with the herd mentality and thinking like they do. So this is the scenario here. Feels like we're trying to carve out a bottom. In fact, if we zoom in a little bit more, we have what I call an impulse move. If we were to draw on the chart, an impulse move means we have a move up that breaks two previous highs. We have one high right here. We have another standout high over here. In fact, we even broke this one here. We broke this standout high as well. So we busted through 3 layers of resistance, meaning there was enough upward movement that it cleared through resistance. And after you break through those, usually the first pause and pullback can become an opportunity, a buying point where it'll have the next leg up and then figure itself out and then the next leg. So it does feel like we're carving out a very short term, stage 4 decline, a mini stage 1. It feels like it's now. And if we go to the monthly chart, you can see the projected upside here. I don't think this chart goes that far back. Upside projection. I mean, if this was to totally blow up in a huge crisis, which I think we're on the cusp of, we could see this exchange go to $1.73. So holding US dollars is a very lucrative play percentage-wise. That's a big potential move. Even if it just goes back up to this level, 153, the golden ratio of 618 extension, it'll be a huge, nice boost as well.
Although gold hitting about $4,100 could result in large profits for investors, it would also likely foreshadow a severe economic crisis in the U.S. and around the world, characterized by rising inflation, a declining dollar value, and investor flight to safe havens. This situation, which is linked to slowing development and possible financial instability, is similar to previous market trends in which gold rose when stocks soared and subsequently fell. Through 2025, volatility may be exacerbated by changes in the U.S. and Canadian political landscapes as well as currency markets. How might investors weigh the possible advantages of gold's increase against the dangers of more widespread economic instability? In such a situation, what policy measures might the Fed and Bank of China employ to stabilize their respective currencies? We would love to hear your opinions, so please leave a comment below. If you liked this video, please like it and subscribe for future updates. We appreciate you joining us on this adventure.